Angel investors and syndication. What size rounds will angel investors do? What do angel investors ask for? Will they ask for preferred stock? Will they take common stock? Do angel investors take board seats, or do they sit happily by while you run your board how you want to? How much equity do angel investors take? Do they need to see a proof of concept before they're willing to jump in and invest? What do angel investors look for? I'm joined today by David Weaver, who's the President Emeritus for Cityside Ventures in Birmingham, Michigan. Cityside manages the Birmingham Angels network and an early stage $10 million Great Lakes Angels Fund. I've known David for years. He's been connecting high net worth investors with early stage technology companies and screening high quality deals since 2002 as the president of the first formal angel group in Michigan. He's also sought funding for 2 Michigan startups as CEO. David also served as fund manager and executive in residence at the Pittsburgh Life Science Greenhouse, and he is a founding member of the Michigan Venture Capital Association, now a legendary organization here, and a charter member of the Angel Capital Association. David, the list goes on, but thank you for being here with us today.
My pleasure. Thank you for the honor.
Well, you and I have known each other for years, and we've talked about all sorts of these things in the past, but today we're going to try to put it all together in one place. Because I think as you experience in your side of the business, as we get into being experience on ours, people have a lot of misconceptions about what people in our parts of the industries do. And then they come with all sorts of ideas that just don't make any sense, and a lot of misconceptions. So let's start right here with this first thing that we brought up: angel investors and syndication. Syndication is a term that I think people who are familiar with VCs, venture capitalists, sometimes hear about, but we're never quite sure what to make about angels. Is this a person sitting in their living room saying, I have some extra money I want to invest? Is this a dinner club of people saying, we'll all go in together as part of one deal? When you put the word syndication and angels together for me, I paused and I went, David, tell us more.
Well, break it down, angels, into 3 different categories. Individuals who will not belong to an organization, but find a deal they'd like to invest in. That's one group. Then there's members organizations like Birmingham Angels, where people belong to an organization that helps select the deals for them, help them with the documentation to get deals done, screen them, and all that stuff. Then there's funds, angel funds, which an investor can put money into the fund and be in 30, 40 deals over the life of the fund, but at the early stage, unlike VCs, which come in normally for growth capital after a lot of the market adoptions in place. They need money to grow the market presence and get them ready for an acquisition or an exit. So angels are in early if they're individuals or in a group or part of an angel fund. They're looking for an equity position, early stage company. Most often, at least ourselves and others, like companies that are at the pre-seed or seed round of capital raising. So if you're an entrepreneur and you're trying to raise after your family and friends have kind of tapped out for what you can do in a way of getting some capital to get started and move into the company full time, you're trying to raise $500,000 to $1 million, $2 million. You now need angels. You're too early and too small for VCs to mess around with. This is the space where angels like. They like this space. But if you're raising around 500 or more, no group likely is going to do it by themselves. A fund is going to want to necessarily do it by themselves. So you have to think about syndication from the beginning. That means that you need to know that other angels and groups or in whatever sector they're in are going to want to have other people come in the deal. So if you're raising like $2 million and you're looking for somebody to get it started, a lot of people don't like to take the lead on something that large because they're worried about you spending 9 months trying to close a round and spending their money doing the running around and not putting it into the company operating it.
Because if you don't close that, they turn out to be sort of the only investors, even though it was supposed to be.
And they don't want to be in so early that it takes a long time to get a second investor in it. And so if somebody's going to take the lead, most likely they have an idea who they're going to syndicate with. They'll get close to the end of the round as soon as possible because they want you to execute. Stop chasing the money, get all the money you can, and close the round and execute. So the idea is don't go to one or two angel groups when you're trying to raise money and think, okay, I'm good. I'll just wait to hear back from those folks. Go to everybody you think that would be in your sector that would invest in you, whether the in-state or out-of-state, and be prepared with a slide deck at least to get started with that really gives a full story. A lot of people put together a slide deck that talks about the technology, but they don't really talk about the business. They don't talk about how strong the management team is. They don't talk about their IP. They don't talk about the go-to-market strategy, the user proceeds and exit strategy and stuff like that. Angels are in a company because they want to be out of a company, like VCs. They go in to get out. So they really want to know how you're going to raise enough money to be attracted to be acquired, IPO, which is not likely. And so they want to know what your plan is to get there, how soon you get market traction to be on the radar for folks. Now, the equity position that angels take is unlike VCs. Normally when VCs come in, they take board seats and they do syndicate. If you're raising a $10, $20 million round, they normally don't take it by themselves. They bring other people in to spread the risk. Also have people that come in the next round beyond themselves and not do everything by themselves. And so angels like to also have other people in the deal, but we're not after major equity and board seats necessarily. If you're raising a $1 million round and somebody wants to put together a syndication or group says we'll take 250, they could ask for a board seat. You probably ought to give up a board seat. They come in at that level because they'll bring a lot of value added on top of the money. And you need outside people in the company. They'll give you a horizon of what to think about that you're not thinking as just being an insider. So the amount of equity depends on how much you're raising. If it's say it's $4 million round, you're raising $1 million, you're giving away 1/4 of the company. So post, it's going to be $5 million. So there's post and pre-money is what people talk about. So you need to think about that when you're raising the money, how much you're willing to give up. So, but they're not after. They don't go into a deal thinking, well, I want to have at least 30% of the company. How much you offer versus what the size is what they get. That's what they're going after. Angels, they'll look to see, I'm not going to do unless I at least have 50% of the company. That's not going to happen. We actually don't want to have 50% of the company. We want the founders to have a large stake in it, so they're driven to make this successful.
And they don't usually see themselves, angels don't usually see themselves as contributing sort of the lion's share of the funds per se. They see themselves as boosting this and getting it to the next level.
Yeah, we look at, our group at least looks at companies that would most likely have an exit, an acquisition with 3 to 5 years. So that gives them enough. We want them to be either, we'll look at companies pre-revenue. A lot of groups won't do that. They want you to have revenue first, almost acting like a VC. We'll look at pre-revenue companies, but they have to be close to revenue. They have to have proof of concept done, so we know there's market validation that the service or product would be bought. Now they have one together plan, but within the next 12, 18 months max, they would start having some revenue coming into the company. And we believe we can count on that. We know it always takes longer. It takes more money than people expect. So we kind of build that into the expectation of how much we're going to fund them and how long we think they're going to take versus the milestones that the company thinks they're going to take.
Often we've found that people, if they come asking for either too much or too little, it's a turnoff to an investor, because it's like, if you come asking for too much, well, I want you to be more focused. And if you come asking for too little, it's like you don't understand what you're in for.
Yeah, we've had some companies saying, well, we only need 500K and we'll get to this milestone, and then we'll go and ask for some more. That milestone is not going to be enough to raise the next round. Why don't you just make it $1 million? We're trying to grab more equity, but we're saying you need more money to get more proof to show value added when you go to raise the next round of money.
Because we don't want to be having that conversation 6 months down the road as to what else needs to happen now. David, I want to take you really back really quick to the question of syndication. So with VCs, I think it's a very common concept. What you said with angels is, if I need maybe less than 500,000, maybe I'm going to an angel. Maybe if I need 2 million, I might need to syndicate angels. Take me through how, as a startup founder, how do I know whether I should be trying to get angels together to syndicate? Who should be leading that? How would I know if that was likely to happen? Or at what point do I sort of go, no, I know my next raise is going to be, 2.25 million. I'm just going to jump and go straight to VC. Like how does one know which pond one is swimming in as those numbers get bigger?
Yeah, we anything 2 million or less is really in the space for angels. Like I said earlier, I wouldn't go to VCs. You'd get their attention only if you want to educate them about what you're doing for the future, but not to raise money from them. So if you think you're going to need 15 or 20 million much later in your life cycle, then it's good to have some VCs and know what you're doing, kind of see whether you're reaching your milestones or not. But we syndication could start even at 500K. If we decide we're going to come in a company at 500K, we're not going to take the whole round by ourselves, even if we had the cash. We would maybe take 100 or 200 of it and syndicate the rest of it. What does that mean? That means if the investors, it behooves them to know about other individuals or angel groups that they could bring this deal to on behalf of the company with the company's support, and to make introductions for them to take a deal. Like some companies have come to us recently, raise some money. I've gone to Point Angels. I've gone to Angels in Traverse City. Northern Michigan Angels have gone to Grand Angels and said, listen, here's the deal we're taking a lead on. We'd like you to take a look at it as well. So that's us doing the syndication. But the company shouldn't wait only for the investors to syndicate. They should say, well, I know a group over in Toledo, or I know a group in Cleveland that I've got an introduction to. Should I approach them? Hell yes. You want to have a lot of hooks in the water. You don't know which fish is going to bite and for how much. But you do want to make sure it's coordinated so the people that are in the deal already know who else you're talking to. You might say, oh, I know some folks in Cleveland too. Tell me who you know, and we can share due diligence and stuff with them.
So it's not really, there's no strict rule of, oh, the angel leads the syndication or the company leads the syndication. It's really have the conversations. If you introduce an idea to some other investor, you're kind of going, make your own decisions. But then if it just sort of naturally emerges, you guys might be the ones to suggest syndicating to the company.
Right.
That's fascinating. And again, something we often hear with respect to VCs, but something that the angels do. And I love the hard numbers there of less than 2 million, let's think angel, more than 2 million, let's think VC, which answers the size of the rounds question. I also like what you said, David, about like the equity, that angels aren't in it for how do I get as much of a percentage of this company as possible. You also talked to us about board seats, that it's not necessarily the goal of it. Although I imagine as an angel, you would take a board seat based on the specifics if it made sense.
Yeah, we've had some investors that have had asked to have, will oftentimes ask to have a non-voting board member from our group be on their board committee meetings when they have them. And then sometimes that relationship grows into such that the company says, listen, this person's really contributing a lot. We like to add them as a board member. And sometimes, depending on the size of the investment, we might insist a board seat is part of the investment. It plays different ways, but we do like to have knowledge of what's going on in the company.
Yeah, that makes a lot of sense. Well, this is a question I know a lot of people are wondering about, but preferred shares versus common stock, how does this work? And as you get into these term sheets and stuff, it's like your head, if you're new to this, can swim as to, I didn't realize there were so many ways to take equity in a company. Tell us about that.
Yeah. Founders start a company with all the shares being common stock. And if there's later stock options offered at some point in the company, normally after they're a C Corp, it would be out of the common shares. If angels come into a deal and they know there's going to be later rounds, most likely they would insist on having preferred shares. The reason is when there's other money coming in, especially if there's VCs and you're common and not preferred, you don't have voting rights and the ability to negotiate like a VC does with some of the things that happen to the company later as far as fundraising and other activities. So you want to have preferred shares, especially if VCs are going to come in later, or you believe they're going to come in. We typically ask for preferred shares at the get-go, even if there's no later rounds, because you never know what's going on. Now, the type of investments are both. There's a vehicle called SAFE, which we find has come out of the West Coast. It's for future. It's a securities for future equity type of thing. It's a promissory. Founders like this because it really doesn't affect their cap table. Angels, we do not touch them because it's not a securitized investment. It doesn't show up on their cap table as debt. We like either convertible debt, which means we agree with the founders. We don't know what the value of the company is, so we'll ride with them on what the company's going to be at the time of conversion, because there will be a conversion date. If you take convertible debt, either 2 or 3 years later, it'll convert at a certain discount to the future round. Normally, it's like 20%, maybe 6 or 8% interest during that period of time that it's a note, or price shares. So there's 3 different ways: safes, convertible debt, and price shares. Price shares mean you're doing $4 million round and you're raising $1 million. That's price. You know immediately what your equity holding is on that. Convertible debt, you don't know until it converts what it is at a later date.
That's really interesting. I've heard people talk about the safes, and I got the impression, it sounds like you're sort of confirming that a safe is a little bit of if an investor wants to give money to a startup and they don't want to quite make it a grant, but they're not really worried about protecting their interests, they can sort of do a safe just to make it easy. Is that oversimplifying it?
Well, that's a good analogy of what it is. You're giving the company the money of the company with a expectation that they'll pay you back at a later date with, and even there's discounts and conversions on that. But it's not securitized. If the company goes under and you have some IP, if you're in there as a debt holder or a price to equity holder in the company, you have some rights to whatever the value of the company is if the company dies. If you're a safe holder and that you've lost it, your money's gone.
So a safe holder is really saying, I'm in it for the upside, but if it doesn't go well, I'm not even going to try to I'm sort of just not even going to try to cut my losses.
Well, I understand the risk,
Mm-hmm.
Yeah.
That makes sense. Well, people are always interested. What do I need? When should I approach an angel? What do I need to approach an angel? What do they expect me to know? If my company's an LLC, is it still okay if I go to angels? Do I need a proof of concept? What kinds of documents do I need to go to that? Like, I don't have a clue. I just want money. Like, what do I need?
Right. Almost every company starts out as an LLC, and that's fine with us. Probably over 80% of our companies are LLCs, and some of them have been around, 3 years already plus. LLCs are favorable to angels in one way that most of the companies are still in R&D, so there's R&D tax credits that can benefit the investors if it's an LLC. But LLCs need to have, for us to invest in, at least one or more full-time employees in the company. Some people say, I'd like to raise $500,000. As soon as we do, I'm going to join the company. I'm sorry.
That's an interesting
If you're
one.
not in the company already, we're not funding you to get into the company. We will fund the company to operate, but not you to join the company.
You're bringing a vehicle that is running, and you're saying, here's how I want to keep it going. You're not bringing something and saying, I want to start the vehicle.
Right. We won't fund that. I don't know too many people that do. So we'd like to see at least one or more full-time employees in it. And because it's a startup, whether it's LLC or C Corp, there is no history of sales in most cases. So how do you put a value on your investment in that company when you're looking at it to figure what they're going to do and how much money you're going to put at risk in the company? So we believe that probably close to 6% of the decision on a company is based on the founder and the founding management team. They have to be strong drivers. If they don't have real strong experience in the domain they want to enter with their business model, and they're not really committed to this, and have good knowledge about the market during the Q&A and stuff we have with them, we're going to take a pass, even if it's a very attractive round, very attractive product. We got to believe they're going to be able to execute. Execution is where a lot of companies fall down. They raise money, have some good talent, but they don't know how they're going to go to the market and execute. So we got to believe the management team is very, very strong. And unit forecasts, when somebody's doing a unit forecast and a dollar forecast, we want to get into their head and figure out how they, when they first start having sales, whether it's a product or service, who are their first customers, how long is it going to take to get them, how they're going to get there. They should know that in a lot of detail, quarter by quarter or month by month, at least for the first year. And after that, we know it gets to be more and more fiction. It's not realistic, even at 5 years, to know what's going on. But we want to see that somebody's thought it out beyond year one. Let's say I've got my first year, I expect to have contact with 750 buying clients, buying at the following rate, and it scales over time. Not everybody starts at the same level. So my second year, I expect to see that same 750 plus another 1,000 on top of that, scattered over each quarter to get to this revenue stream. So you have to have some kind of logic that we can follow, that you're really building those numbers based on a real process that you run through your head, rather than think, well, I'm going to do 20% better the next year. No, we want to know how you build it, just not what the percent increase is.
Because the investor is investing in something. It's not just a product. It's not just an idea. It's an actual vehicle moving towards a destination. And if you can't say what that destination is, and we find that in our business too, of development, medical product development, is like, if you can't tell us what your goal is and overarchingly what you want to accomplish, we can only help accelerate you. We can't completely invent your market and your product and everything else for you from the get-go. I just want to mention to our live listening audience, if you have any questions for David, you're welcome to punch them in, those on YouTube and those on Zoom. If you're on Zoom, you can punch it into the chat or raise your hand. On YouTube, there's a chat there too if you have any questions for David about angel investing. And David, in terms
on the
of...
same topic before you move on.
Yeah, go ahead, please.
We like to see, we have our own platform. We ask companies to get on and ask a lot of questions. Some people get on our platform the first time, they go, Jesus, you're asking too many questions. This is it takes like a couple hours to fill this out. Well, you know why we ask all those questions? Because if we like a company, we want to move quickly on due diligence. We save a lot of time if you put all the information into our platform early. We're not going to have to chase you down and say, well, listen, I need to know about your operating agreement. I need to know about it. So I can't get to it until next week. Well, then, we just wasted a lot of time. So we like to be able to close on funding, if we're going to do it, within 60 days from the time you present to our angel investors. And having all the information collected allows us to make that happen with our due diligence team, what you provide us. So we want to know, when you put your pro forma together for 5 years, when do you think you're going to be at break even? That's important to us. We like to know when you're stop chasing new money. You can go to the bank and raise the money. And stop diluting us.
And yeah, right. That I think is the thing. And it's one of the things that I think sometimes the VCs actually find themselves in a slightly harder place in, because they have a hard time distinguishing themselves sometimes from investment bankers, right? And so you guys are really taking that risk. You're really upfront. You're taking that risk. This is like Wild West investing at its finest. But I think your point about coming, if you're going to invest, you're going to do it now. You're not going to wait, because you're looking at that exit. You said earlier that you go in to get out. I loved that term. I've never heard that in all these years, David. That's an awesome way to succinctly put it.
It's true. We're in the tech space. The technology doesn't sit on its hands. If you don't get in the market and take a presence and start scaling, a year later, somebody else is going to be there and you're behind. So if you got a great idea, we want you to have the money, Get out there and get a presence. So you're the one that dominates the market, makes it attractive for buying your customer base and buying your product or service. Okay, so move quickly. We don't want to drag our feet. We don't want you to either.
Yeah, that makes a lot of sense. I got one more documentation question, then we're going to go back to, I want to talk a little bit about the distinctions between VCs and angels, and also post-investment follow-up. Like we haven't even talked, we were only talking about how do you get angel investment, but what happens afterwards, I think that's a really, the care and feeding of your team is a really important question. But pre-investment, going to angels, are there documents, a startup CEO should be bringing, term sheets, offering documents? Are these things that you help with? Are they things that they come with? How does that work?
Well, I've seen the model changing. When I was raising money in 2010 for a startup, I put together a 2-page executive summary and a slide deck. Now I'm seeing that angel groups like ourselves are just happy with a slide deck to get our attention. And then we'll dig our teeth into that with more information with our own platform or Q&A and stuff like that. So documents, we want to see a well thought out slide deck that covers the most important points that we want to know and need to know what those are. I have a document that I could forward to anybody who wants to know what a slide deck should have in it for raising money from angel investors. When you come to us, we want you to have that well thought out. We want you to understand that we will be asking for an equity position. We will be really your partners, just not investors. When you get money into your company, we are now your partner in your company. So we want to be treated like that. If you have problems that come up, don't hide them from us. Tell us about it so we can help you with it. So it doesn't become a gotcha. Oh, damn, I wish I told you about that. Let us get to it early with you to help you. We're not there to criticize you. We're there to help you. Oftentimes, we're available to be advisors to the company as needed. We've got a lot of talent. We've got engineers, we've got CFOs, we've got lawyers, we've got all kinds of talent in our pool of investors that can help you. Also with opening doors to help you get into new clients and stuff like that. We want to help you. We have a vested interest in your success. So we're not there to beat you up. We're there to help you.
Yeah, it's interesting. People often have an almost adversarial approach to it, and that never leads to good things. I brought up on the iPad. Maybe there's another address you'd like me to punch in, David. But just in terms of how people should get in touch with you, I know your association with CitysideVentures.com, which I have the website there up on the iPad. Any other contact information you'd like people to have as we go into our final few questions?
Well, yeah, a lot of people know where to go to find angels. And Spark in Ann Arbor has a list of all the angel groups in Michigan. But beyond that, there's a nationwide directory, and it's www.angelcapitalassociation, 3 words connected.org with a /directory, where you just go to their website and find it. They list angel groups that are part of that organization. They're nationwide and even overseas. When I joined it, it was a national organization. Now it's international. Angel groups all over the world, and you really want to go to an angel group that understands your space. Look and see if they have a portfolio of companies similar to what you're doing, because they'll get it. If you bring a life science company to somebody that just does SaaS, and you're not a SaaS life science company, you're going to get a deaf ear. They're not going to really spend time with you. So do your research, find out what they're looking for, look at portfolio companies, look and see what the methods are for approaching them. The best way to get to an angel is really a referral. We see companies come to us all the time across the transom. We'll take a look at them, but it's different if another angel group sends us a deal. Hey, we took a look at this company. It doesn't fit us, but we really like it. You should take a look at it. Or here's somebody approached us, and we send them to you as well.
Those warm introductions are key. Even a warm introduction that comes from somebody who says, I'm not going to invest, but this person over here might be interested.
Yeah.
And here we've got up on the iPad, if Steve can show it here, the angelcapitalassociation.org. I believe we've got the right website up here. Let's see if we can pop that up. What's that? Oh, he's not getting my screen. Well, we have technical difficulties.
No, I don't see that, but that's okay.
We'll see if that comes up. But Angel Capital
The other
Association
viewers can see it.
.org, the ACA member directory. We'll punch that link into the YouTube description after the show, so people can get to that and to Cityside Ventures. No, that's a great connection to make. Let's talk for just a moment, David, about angels and VCs, because you said something to me interesting before the show. You said we're seeing a lot of deals where we invest as angels and it never goes to VC. And I think if somebody were narrating the typical process, it's like, well, go as far as you can without equity investing, do all the grants you can, and then take equity investing late. And then you're going to go to VCs, and pretty soon you won't own your company. And, oh wait, is that how it works? But you were telling me, no, there's situations where it never goes VC and you make exit with angels.
Yeah, when I started this in 2002, a lot of the companies were raising capital, said from the business school, they were told to write a business plan, executive summary, and a slide deck, and we'll talk to the VCs about raising some money. They quickly learned that if they're raising $2 million or less, even $3 million or less, VCs say, well, that's not us. We don't touch anything that small. We look at only deals in $10 or $20 million. They go, where do we go? The angels. That's why I formed the angel group that I did, so that there was a platform for people to connect each other. Now, the difference between the VCs and angels is we're not providing growth capital. We're really providing true seed capital to get the company solid with its customer base, it's building its management team, and getting initial sales in the marketplace. That's our goal. We want you to build enough of your team and outsource as much as you can rather than hire a lot of people. There's some people who do outsource software development rather than hire somebody full time to do it. And then you've got to develop now. What do you do with them? Who's on your payroll? Think about how you build your management team. How much can you outsource? And then we like companies that are going to be flexible. We've had a number of companies that have come to us, start out. We really like them. We like the founder. They found out they kind of stalled with the product idea placement they had, and they pivoted. And we put some more money into because the pivot they went to is much stronger than our initial expectations of the company. So be flexible, get back, stay in touch with the marketplace, be willing to pivot, be solid. Well, I don't know why this isn't working. It's really good. Listen, if it's not working, it's not really good. You need to find out from the marketplace what you need to do and whether you're the right people to do it.
It's interesting how when we talk about like trends, what are trends? How do I think about this? What are patterns that I should see? We almost sometimes forget that the whole reason new ideas are being put out there is because it's never quite been done that way before, and we're trying to find something that doesn't exist. So it's like you can learn all you want, but if you're not paying attention to the data as it comes back, we're missing something.
Exactly.
Well, what happens, David? What happens after? So I've gone through all of this. I've courted angel groups. Maybe they syndicated together. They invested fast because they don't want to wait for that exit. They want it. They went in to get out, which I love. How do I take care of my investors? How do I keep my investors happy? You talked about some of it, which is I want to know if you're having problems because maybe I can make a recommendation. What else?
Yeah. I think the best way to take care of your investors is have a forced discipline. Once a quarter, put together a newsletter to all your investors, recapping what you told them you were going to do in the last communication for that quarter, how you did against it, what you're going to do for the next quarter, what milestones that means, and how that's going to hopefully change the valuation of the company because they want to see inflection points of raising the value. And then put together a P&L so they understand where your cash position is. Let them know what your current burn rate is, how long that money is going to last you. Is it going to last you 12 months, 18 months, your money in hand, or the next raise, what that's going to do. Do that every quarter so they have a track record. If this company is paying attention to its investors, it's keeping us informed. And if you didn't make your milestones the last quarter, you're explaining that in the next newsletter. What slipped? What happened? Because Murphy's out there. Stuff is going to happen. You didn't twist it. It may not be your fault, but we want to know that you've recognized it and doing something about it and told us about it. Don't keep it hidden. So I think quarterly reports generated from the company to the investors is the best way to deal with investors. Don't wait for them to ask you. it really shows that put your heads above the other people that are not doing that. They're not thinking about the investors that way. They got the money, and we'll tell you once in a while what's going on, send you updates. Well, formal newsletter is much better.
It's really faithful stewardship of what you've been given. Recognize that you're holding this in trust and give reports on it.
Yes.
That's huge. One last question for you, David. We were talking the other week with a venture capitalist and talking about what's happening in the market right now. I think you alluded earlier to the fact that as VC markets are going down, so too angel markets. Any specific trends you'd like to call our attention to, or things? What are you seeing? What kinds of deals do you say, wow, I'd really like to see more of these? What kind do you go, wow, that's really stagnated? And any trends you want to tip towards?
Well, as far as the funding side of it go, we're seeing VCs, large VCs, and private equity funds kind of nurturing their current portfolio, not willing to expand on it much. We're seeing some of the hype for green energy is diminished. It's not as strong as it was before. And I won't give the reasons. I think that's part of that, but that market's kind of lost its luster for being a great opportunity for investment. So the ramifications are for angels. So there's a discipline now to be very cautious as to the true valuation of the company when you come to us. If you're raising like $3 million or $2 million and you think you're a $15 or $20 million company, for the value of the company at the time of the raise, you better have strong reasons why that is the common thing in that market segment. Every market segment is different as far as the valuation goes. But I don't see companies coming to us raising $2 million saying they're going to be more than $8 or $10 million valuation right now. And sometimes less than that, depending on how long it's going to take them to get to market and how much more money they're going to need. We do find companies, as you mentioned before, coming to us, like one we just invested last month is only $1 million, maybe $1.25 million round, and we're taking a lead on, and we think this company will be acquired in less than 18 months. We'd love to see a company will flip and maybe be a 10x or more return for our investors because we think this is really a hot company. That's unusual, but we do like companies that know they are in it to grow it and be out within 3 to 5 years and have a way to make that happen. And they've had some early discussions with people, maybe potential acquirers. Just listen, here's the space we're in. I know you've done some stuff with Google or whoever it was before, Apple or Amazon, and we're in this space. We think this might be of interest to you. Would you like to follow us? Not asking them for money, but they go, oh, geez, maybe we should get these guys on the radar. And you start showing traction in the marketplace. Hey, we'd like to talk to you some more,
Because once you hear about something and you see a trend forming, it's like, okay, hold on. Maybe time to get on board.
And like this company we just invested in, some of the people that supply product like they have in the marketplace, already approached them. We'd like to know when you're in the market. We'd like to talk to you. So I want to take them to a place where we have a bidding war, where we have a number of people wanting that company, just not one or two. And so it drives up the value.
That's the way I think a lot of big exits in our own space have happened. Is you get to that place and it's like, I got 2 or 3 companies that are saying, hey, I need this technology, I need this product, and that's when they really the exits you hear about. That's how they tend to come to be.
Yeah, normally when you get close to an exit, you do want to be in a C corp, which brings different levels of funding and responsibility. And you put together a board. Now they have fiduciary responsibility. Need to have D&O insurance. Need to have liability insurance if you haven't had already when you went in the marketplace. Now, some companies one I mentioned earlier, they have a really strong technology person that's key in the company, whether it's a CEO or a CTO, and they can't afford to lose that person. And I never thought about doing a key man policy. Why would I do a key man policy? $500,000 or $1 million on this person. Why? Because that person, if they get set up in a hospital, in an accident, or die, you've got to replace them. You can't let the company just go down. And where's the money going to be to do that with? You don't want to take that out of the equity you have in the company. And investors like see that their butt covered too, that you've got somebody that can, you have money to raise and find good talent, and
Mm.
bring them in to keep this company going.
Which
So
kind of,
think about key man policy early on. If you got somebody that's really, really strong and crucial to the success of the company, early when it's cheap.
the fact that you
And
even bring the key man policy up sort of doubles down on the fact that you brought up earlier, and I've heard many investors talk about, which is we're actually investing in your team. And, sometimes I think people think, oh, well, that's just feel good. Like you're trying to show me that you care about people, but really all you care about is your return. And what you're kind of saying is, no, those people are very central to my return. Like you can't actually separate these two things. We can't discard the people. It's simply not a thing.
right, right.
Yeah, that's fascinating. Well, David, today has been just so much fun. I'm not seeing any questions here on Zoom or YouTube, but any last thoughts you want to leave us with when somebody's thinking about taking investment, taking angel investment? Leave us with the last 30 seconds here. How do you want them to think about it?
Recognize that this is going to be your livelihood for the next 5 years or longer, and you have to be committed with your family that this is going to take a lot of hours and weekends. It's not a 9 to 5 job, and you have to be there, be available to support your team and support the investors and travel when necessary. And look outside the local area for investors. Don't be afraid to have contacts on either coast, West Coast, East Coast. Sometimes they move faster, understand some of the things that are missing in the audience, a very conservative audience here in the Midwest. So be dedicated and be convincing when you have a chance to meet somebody. And like I say in an elevator pitch, have your idea concept down to 1 or 2 minutes so you can really get to the gut of it with somebody. If you happen to bump into somebody that's interested, get their attention to do more. So be prepared and understand this is a journey. It's going to take some time, and you have to be really dedicated along with your family.
Well, that's awesome. David Weaver, always good to talk to you, sir. Just so much knowledge and so much experience in our ecosystem. Thanks for all that you've built.
My pleasure. Thank you, Gene.